Joining me now is Tom Rogers, Eurozone economist at Ernst & Young, and Stephen Gallo, head of market analysis at Schneider Foreign Exchange. Gentlemen, welcome to The Last Word.
Thank you.
The one thing that struck me as I listened to Draghi the whole way through this was, I've given you guys time, i.e. to the banks, rebuild your balance sheets, I've given the sovereigns time, but my question to you guys is this. Okay, they've got time, but we got here because of bank leverage in the first place. We are a long way off from anywhere back to the growth levels we saw of 2007, 2008.
Well, I think that's right, but I think one of the mistakes that pundits and market participants make is that the Eurozone is not just simply as a whole. The Eurozone as a whole is not just simply at the beginning or in the middle of a very slow growth process. It's at the beginning of a very messy, deep structural reform process, which, as it plays out over time, will promote sustainability and growth in a lot of these economies that need the structural reforms most. So rather than just, a hard economic slog ahead, yes, there is bank deleveraging, there are all sorts of structural changes going on within the banking system, within these economies, the labor market reforms in Spain. It looks like Italy is starting to make some progress there as well. The mistake would be to just call this slow growth. And I think what came out in the press conference today, to unite my views on your comment, is that Draghi is clearly putting more pressure on the politicians now. It's clearly verbal pressure on politicians. That came out today in the press conference significantly. Monetary policy can only do so much. It's up to politicians too.
I think that's right, and I think the point about having too much leverage was that there was too much leverage in the wrong place. There was too much leverage going into housing, too much debt being borrowed and taken on by governments. The point you need now is that firms need access to capital with reformed labour and product markets in countries like Italy and Spain, and that's the leverage that will start to drive growth again.
Is he trying to balance the ECB, his board in front of him, that challenge between inflation rearing its head in Germany and really trying to hold on to the growth story or try to promote growth?
No, absolutely. I mean, we all knew that the Eurozone was going to have a two-speed recovery. It seems that Germany is actually starting to slow as well now in the last quarter, but wages seem to be picking up. There are inflationary pressures. And so there is a balancing act between keeping those inflationary pressures under check and supporting growth in other parts of the Eurozone.
I think generally, I think one of the things that definitely came out in Draghi today, and some private sector economists even calling him hawkish. But I think what he's trying to do...
I didn't want to use that word myself, but go on.
Well, I think it's more complex than that. The situation that is going on in the Eurozone overall and within the ECB, those corridors of authority, the ECB, is a very complex situation. But I think what he definitely tried to do today is try to merge that facade that he's gained himself since his presidency has started of the caretaker of the wholesale funding markets and the money markets with a more traditional style of setting ECB-style policy, much like we were used to under Trichet and obviously Trichet's predecessor, Duisenberg. So there's definitely that merger. I think he's trying to merge those two faces, the faces of the wholesale money markets caretaker, LTROs, liquidity, yes, and traditional style of ECB policy setting.
Do you think the market needs another slug of liquidity? We've got $1 trillion, but it's going to take time to work out whether this worked. Tom?
Well, I think we need to see exactly what they're going to do with the first $1 trillion, to be honest, because the ECB is due to release another lending survey at the end of this month. It would be fascinating to see whether there's any evidence that the liquidity they've provided so far is going into real business lending. At last month's press conference, the ECB said that they were starting to see some signs of that. So I'm not sure they need to do any more before they really know what's happened so far yet.
I'm going to move the debate on. We've got the Fed on pause.
Is it debate?
Well, it's a debate. Is it? Well, it's supposed to be a discussion. It's a debate. I haven't heard you two argue with one another yet, so let's crank it up a bit. The Fed's on pause, and the ECB we've just discussed. Is there a risk here that we run into the thing that we've had before, which is we run out of growth by the summer?
Well, I think the situation, is the style of the U.S. recovery in terms of what we know historically and what seems to be going on now. If you look at the auto sales, there are definitely credit channels opening up. Some of the growth rates in credit growth for households, consumers, they're picking up. So the U.S. economy is very sensitive to higher rates. So the Fed has to walk this very narrow line. Not that the European Central Bank and the Bank of England don't either. They have to walk this very fine line between how strong the recovery actually is, the underlying recovery, and what they can actually do verbally to monetary policy expectations and actually interest rates themselves.
I think there's also a danger that you get so used to having stimulus after stimulus that you rely on it to provide. Well, possibly.
We're already there, becoming junkies. we're deep into that candy shop. We've been there a long time.
Some of the most important stimulus that we had in the first couple of months of this year was actually policy stimulus from countries like Spain and Italy, who were delivering reform and restoring confidence in people lending to them. And that's the kind of stimulus that we need more of through the rest of the year.
I want to talk about Spain. I mean, demand for 3-year bonds dropped by 50%. Are we going to see a big explosion in risk in the periphery? Tom?
Well, part of the reason why Spain's bond yields have gone up over the past couple of weeks is partly because they've been front-loading it so much, trying to borrow in advance of needing this cash. So that's obviously part of the story about why bond yields have gone up. Another part of it might be due to the fact that they've announced some slippage on their fiscal targets, and that's definitely something that needs to be monitored very closely.
Should we be more concerned?
I think Spain will need probably more support. What form of that support will take, whether it's going to be the S&P becoming more active again, it's difficult to say, but I think it's very important that these countries where the structural reforms are needed so badly have the breathing space. The politicians need time. They have to have the ability to carry these reforms out, and they can't do it with an overly tight monetary policy.
Markets sometimes don't give politicians time. Very quickly and very briefly.
Okay.
QE or not QE in the UK? We've got the Bank of England tomorrow. What's the possibility? Tom?
We don't anticipate any QE at this juncture. I mean, we'd have to see, a couple of months down the line what happens, whether the recovery proceeds.
So you'll give him time,
yeah.
Mr. Gallo?
I think there's a risk that we actually see a move to more, focusing on the potential for tighter policy in the UK before we see a loosening of policy again. But I actually think the risk is very high, and I don't know how you prepare for this or trade this mess, that they hike interest rates, tighten policy a bit, and then do more QE afterwards. So that's a really interesting combination of events.
Okay, gents. Tom Rogers, Eurozone economist at Ernst & Young, and Stephen Gallo, head of market analysis at Schneider Foreign Exchange. Thanks for your time.